Hello to all of you. Well, welcome to WealthE Wednesday and another exciting session that we've got. And we're very excited today because we've got a guest, which Alex very kindly organized. So, Prof Viruly, it's fantastic to have you online tonight. Real honor and a privilege to be able to share your knowledge and your insights with our community. So thank you very much for being part of this webinar.
Yeah, it's great to be here. Thank you. Thanks.
Lee, thank you very much, as always, for organizing it. And Alex, equally from your side, as one of the key members within the community, I think what's important, and tonight we're going to run through a conversation with the Prof. And I do find it quite uncanny because I was at UCT, I graduated in 1998, so it's a 22-year journey since I left the Prof's department at UCT. And
well,
so
it makes us proud. It makes us proud, Scott, to see people like you in the industry. It gives us a sense that we're doing the right thing.
Well, the good news is actually what I studied and even what I did my dissertation on in 1998, I'm still to this day doing, which is how to use technology in the property industry. So it's interesting. So what I want to do. Sorry.
So you were probably ahead of the time at the moment, before people were talking of blockchain and many exciting other things.
I tend to joke with people when we did the dissertation, or when I did the dissertation back in '98. I tend to joke most people couldn't spell IT, but in this industry. So anyway, but let's rock and roll. I want to give a little bit of an introduction, and as I said, it was a very unexpected but fantastic opportunity. So I've got a bit of an introduction, and then I want to go into a Q&A. What I was going to be focusing on tonight, because a lot of our clients have been saying to us, what's happening in Europe? There's a lot of talk at the moment around Europe. Why are people focusing on Europe? So that was going to be one of the focuses, but as I said, we're going to go with the ebbs and flows of tonight. For those of you who missed the lunchtime session, as you know, that's the onboarding. If you're interested in deals or any of the deals, etc., we went through that, so you can literally get that information. And then, you see me talk a lot about this at the moment, but the right information at the right time is 9/10 of any battle. And what's interesting is that, the Prof's going to give us some more understanding around this, but if you look at the different market crashes through time, that the worst supposedly in the last 120, 130, 40 years was the Great Depression. And America lost 50% of its banks, unemployment was 25%, the stock market lost 80%, housing prices lost 67%, international trade went down 65%, deflation soared 10%, and it took 25 years for the stock market to recover. And what I find fascinating is that Joe Kennedy at the same time, so the father of JFK, during that time actually increased his wealth 45 times. And people said, how did he do it? Well, the first thing is he had a passion for facts, a complete lack of sentiment, and a marvelous sense of timing. And so, it's really interesting because I applaud you for being online tonight and coming and learning and getting the facts. And the second thing is that he used a lot of it within real estate. And so there's a lot that we can learn from these different crises, and we all know the different ones that have happened through time. And now we've got this coronavirus, and we're going to talk tonight about whether the impact it's going to have. What we do know is that if we look at the press and everything that's out there, there's a lot of talk around what's the major impact. Is it bigger than the GFC? Is it going to have a massive impact on our economy? We've got all the different stats. Something like 8.8 million Americans lost their jobs in the GFC, the global financial crisis, and yet 22 million lost them just in April. When you look at household wealth, 19 trillion was lost over 4 years, and yet in April, 9 trillion was lost in America, etc., etc., etc. And these things are all the interesting stats. What's quite interesting when it comes to property, 31% of residential tenants in America didn't pay in April, and 85% of commercial retail tenants didn't pay. There's talk of what's happening in the UK. And what's also interesting is that in the first world, there's a lot of stimulus going into the economies, but what will be able to happen in the emerging economies? Stock markets have taken a beating. They've also recovered, real estate, crypto, etc. So as investors, we're all sitting here going, well, what do we do? And that's the question we ask, where to from here? What do we do? And I just wanted to share with you a highlight of just some of the things that I put together for a video we did. Warren Buffett says, don't lose capital. And the second thing is focus on income generating assets, be it property, be it the stock market, it doesn't matter, but focus on income generating assets. And as an example, he loves Coca-Cola shares because they're diversified across 200 different countries. Jim Rogers says, don't panic. And he says, focus on where the world is going to. So again, don't focus on the impact coronavirus is going to have next week, particularly in the property industry. Where are we going to be in 5 years, and what have you got to focus on? And this was just a picture of me and Jim Rogers years ago when we were holding up each other's books. Jeff Bezos says invest for the long term, solve customers' problems. And what's also really interesting is that he's investing very heavily in these times, in fact, $4 billion. And finally, Ray Dalio, and many of you have heard me say this before, but he talks about diversification across assets, within assets, across markets and currencies, and across time. Now, I've got a little video that I'll share with you later if we've got time, which is the TED Talk by Ray Dalio. And I would highly recommend that you actually go and look at that. I also believe you need to look at diversification across partners. And so this for me is the video. But the question you've got is that when we look at the global markets and we say, well, where do we invest? Do we invest in South Africa? Do we invest in America? Do we invest in England, Europe, Australia? You know, what do we do? And the whole idea for us is that with technology, we're trying to take away the guessing work. So we're trying to actually help you be able to decide. So if you want to invest in South Africa, England, America, Australia, Germany, whatever, you don't need to choose anymore. And so I just wanted to share one last thought before I move to the Prof and his insights. And that was that we did a webinar last week, Thursday, with James Painter. Now, I highly recommend going and checking out James. This was a picture I had years ago where I was doing a presentation with him, and the Rand was at R8.80 to the dollar. We were buying houses in America at the time. The Rand in 2011 had been 6.77 to the dollar, and everyone said it's going to go back to 6 Rand. We must wait. We must do nothing. And he said with a probability of 80 or 90%, it's going to go over 10 Rand to the dollar. And I've been working with him for more than 10 years. And a lot of what you talk about, Prof, which is important, is long-term trends. This is all he focuses on. He doesn't focus on short-term sentiment. And what I find fascinating is that, tonight's not about currency, but if you didn't watch the currency webinar, I highly recommend that you do. I've got, he actually wrote chapter 2 of my book, Property Going Global, which is all around how to map out currencies. And he looks at it very much like the weatherman. It's all about spotting trends. But one of the things I found really interesting was that if you take the pound to dollar, the pound is expected to increase against the dollar by anywhere from 20 to 50%, which is really dramatic over the next 5 years. And equally, if you take the euro, the dollar to euro, you're looking at increasing anywhere from 25% to over 80%. Now, that is the euro strengthening against the dollar. So someone said to me just today, they said, well, do you think the euro is going to be better than the dollar? No, this is actually the dollar weakening. You can see what's happening. Even the Aussie dollar will be strengthening against the US dollar. And what's important is that he talks a lot about the US index, which is then a basket of currencies. 44% of the world's currencies are actually in the US dollar. And what's really interesting is that you can see that the dollar is devaluing against a basket of currencies. And so it's really important to understand this over the next 5 to 10 years as an investor. And the last 2 points which I found fascinating was that even though money supply in America has dramatically increased, and you can see the slide here, how it's literally gone through the roof in recent months, what's actually happened is the velocity of money, so the amount of money people are spending, is actually decreasing. So the fiscal stimulus that they're trying to achieve in the economy since 2010 has actually not pumped money into the citizens spending more money. It's actually been on a decline. And the last thing that I think is critical is the question I asked last week was, well, what happens if America loses the reserve currency? What happens if the yuan or something like that becomes the main currency? And what was interesting, he showed us here that if you look at the amount of money in dollars, it's in the dark blue, and then the euro is in the light blue, and the rest are all sort of inconsequential. And I mean, even the where was the Chinese? There it is, the Chinese one. In comparison, the numbers are just really, really interesting. So without further ado, that was a quick introduction. But Prof, from your perspective, this is what you eat and sleep. You won't probably remember this, but the last time Alex and I saw you was in March at WeWork, and and it feels like a lifetime ago, but it was only 2 or 3 months ago when we were all allowed to be face to face with other human beings at Neil Peterson's event.
Life before COVID, the last photo you took on your cell phone before going into lockdown. I suppose
Well,
we're
exactly.
all.
So much has changed since then in a short 3 months.
But look, Scott, I think you've made a few critical points here. And first, we can talk about long-term trends. And I think this is going to be the important thing. That, you know, I do a fair amount of work on behavioral finance and behavioral economics, and something that has interested me over the years. And there are three things that really influence our thinking and where we have our biases. First of all, it's accessibility. We often just go for the information which is in front of our noses. And we don't think further. You know, in behavioral economics, it's called the turkey syndrome. The turkey who's well fed for 364 days and thinks I'm going to make it, and then forgets that Thanksgiving is on the last day, and things have changed. So you take your forecast of 364 days, and you don't take uncertainty into consideration. So I think we've got to be very careful at what we look at, which we can share. I think I have certain views about commercial and residential.
Do you want me to share your screen with you? I'll give it to you quickly.
Yeah, we can do that in a moment. And then the other thing is where you got to be careful is representative, you know, that you've got certain views, you put them in a box, and then anchoring. Anchoring is something you've got to be very careful of. Numbers that are being shared with you. If I start saying, is the capitalization rate on a commercial above 10% or below, I've anchored you already at 10%. So that's going to be your starting point. You know, and I think you've got to be very careful what you deal with. And I suppose the biggest thing at the moment is how many experts would have seen COVID-19 coming their way. And very few, if any. Why? Because risk you can measure. Uncertainty is something you can't measure. And yes, that's where intuition comes in. That's working with people who've been 20, 30 years in the industry. You know, it's a point I always make to my students, where once they leave the university, they have no intuition because they've got no experience, but they have the DCF and the IRR calculation that they have learned. And I think for those who've been in the industry for many years, they will have picked up that sort of intuition. And I think that becomes all the more important, the more complex the world you have. And they say as human beings, we can only sort of work with 7 bits of information at any particular time. After that, our brains can't go with it. So as we get more and more complex, or scenarios that are complex, gut feel, experience in the property market becomes critical. When things are very clear, then a simple calculation works. Maybe let me put up a slide, maybe just to, and Scott, just stop me if you, wait, let me just get this right. And let's see if this works.
So it should be popping up now. It should be popping up saying share my screen.
Okay, got it. Okay, I take it that you can all see a slide which says Urban Land Institute Emerging Trends 2020.
Yep, got it perfect, yep.
Okay, very good. So now, every year in the US and in Europe, the Urban Land Institute undertakes a survey of where investors want to go, and they rank them from the very top. So you got an investment ranking and you've got a development ranking on the right. The two are slightly different, but more or less they follow each other. Now, where it becomes interesting is that if I'd shown you this 5 years ago, number 20, 21, 22, 23, and 24 would have been on top. Now, what do we see on top? We see logistics. Now, this is important because what it suggests, and logistics, you can argue, is the new shopping center, e-retailing and other trends. And then you start seeing number 2 is residential, 3 co-living residential, 4 private rental, student housing, and then you see healthcare, affordable housing, healthcare, data centers. Now, that's a very different of the first, I think, top 10, about 6 or 7 of them are in the residential. And then you have a few other sectors. And I think what we're starting to see before we go into returns and what countries to go in, I've tested this in a number of countries, and over, I start picking up the same story starting to come through. Globally, there's a shortage of housing. People are going to live smaller. If there's one thing about COVID-19 is that we're going to think more about space. I suppose I've questioned a few people. I've said, if you could have reconfigured your flat or your house, what would you have done? And people would have maybe reconfigured their house slightly different. So I think we're going to think about space. We're going to think about public space to a larger degree. And then you have the bottom. And then let me move on to the next slide. What you see here is going to be quite important going forward. On the bottom, or on the x-axis, you've got benefits to society. So totally on the right, 5 hospitals, big benefit to society, private, the green dots in the top right-hand corners, retail, networks, groceries, the railway systems, important. They are high risk, but they're so important that we'll probably start opening them up. On the left, you have things that are not so beneficial, although I would argue that cinemas are and restaurants are, but nevertheless, they tend to be high risk. So what we really want to do is open up immediately in the economy things that are highly beneficial and low risk, which takes you into wind, solar, data centers, utilities. They're sitting at 3.445. In other words, highly beneficial to society, low risk. And you start seeing the logistics sector once again coming to the top. And I think what we will see over the next year, certainly, is that we'll start opening up, moving from the right of this graph, the whole way to the red dots on the left. And they will probably find themselves opening up a bit later. So I think that maybe these are just the 2 slides just to start off. And I think you can take me off this now. Scott, I don't know whether you do it from your side.
That's fine, I'll grab it back, yep.
Okay. And so I suppose the point that I'm arguing at the moment is that we may even have picked up a few sectors at the end of last year, which were popular, where you start saying now, well, maybe with social distancing, we're going to take a slightly different view. Now, Scott, just stop me. Being a professor, I'm used to talking for double periods, you know, so I just truck on, you know.
Please go wild. It's absolutely fascinating, you know, because such an interesting conversation that you had back in literally 3 months ago. And for me, what's so interesting is to see what's changed in 3 months, because, you know, and whether anything's changed, because like you said, it's the long-term trends, etc. So please know our community is super excited to hear what you think.
So as we entered 2019, we had a lot of the residential, co-working, co-living, and I suppose what's going to come out of this story is that we may question ourselves whether those are such the great sectors. For example, do you have more faith in your corporate head office or in a co-working environment? Which one are you going to go for? I was
literally on a webinar with about 100 top investors yesterday, and that's exactly what they were pitching, was that they saw co-working, you know, where we last met was WeWork, going downhill, because, you know, good corporate offices will want their own primary location where they're completely in control of their you know, the whole environment, you know. And I thought, wow, that's actually a very good way of looking at it. And they were actually saying that's the value add of a single tenant property now.
Yeah, so and I think where it becomes interesting is that the jury is still out whether it's going to be more space or less, because, you know, we were dropping to 11 square meters per employee and even lower, where companies may start arguing we actually need more space per employee. for a bit of social distancing. We're going to take a bit more space to the right and to the left of us to help us through this. So I think we have these long-term trends, and I think let's not underestimate their importance. And so what I'm arguing is that, yes, the next few months are going to be difficult across the globe. Whether you are in South Africa, it's going to be tough. And I think the one thing that we forget is that we've been on a cyclical downturn in South Africa since December 2013. You know, we've been 6 years already in a long-term cyclical downturn. So the balance sheets of companies entering the COVID-19 story was already a difficult one. And throughout the rest of the world, we have property markets that have been performing well. If I take the US, if I take Europe, yes, it is patchy here and there. If you're going for your higher returns, yes, then go to Poland and Central Europe, where you will find it. The rest of Europe, of course, we're sitting on very low interest rates at the moment. And of course, the thing to remember is that when you get a 7% return in Europe, just bear in mind that you compare that with interest rates, long-term interest rates at close to 0 or 1, which is a very different story than when you compare against our long bond rates, which has been moving up and down from 11, 12 now back down somewhat. My view for the next certainly 24 months is that we're going to be thinking a lot more about the residential property market for a while. I think that globally there's a shortage of residential space, whether from San Francisco to Nairobi and to Cape Town, there is a housing problem globally. And I think a lot would need to happen before that gets broken. And I think that when it comes to commercial, we're going to have to pick the sectors very carefully. Like I said, these economies are going to move back upwards, but it will be a train going through the station. And you're going to have to understand what carriage comes first and how they follow each other. Scott?
I like that analogy.
Yeah, and so yes. The other thing is, you know, and I don't want to be unkind here, but I can be. And in property, you have two types of people. You got the property people and the balance sheet people. And when I say that is, yes, for many companies, it is about the balance sheet. It is about LTVs. First of all, the balance sheet people don't have much to do at the moment because there's not much to borrow. There's not much capital, or with difficulties on the capital to be raised. But I think that the property people are the people that are going to get us through this. It's those who have a very deep understanding of the sectors, who understand vacancy rates. You know, and I'm taking the South African example that I know a bit better at the moment. If you lose a tenant at the moment in the South African commercial property market, you'll probably lose a year and a half's income on that space. Why? It will take you 8 months to market the space, 3 months broker's fees, tenant installation, another 3-4 months of income. Losing a tenant in this game is a serious thing, and that's why it's the people who are in the real estate business who will get us through this game, who will get us through the operating costs, who will get us through the vacancy rates. And I think I think that's going to make a big difference where we are now. And then, look, I always say we've got every 20 years we have a big property boom, and it seems to work globally as well. You know, if you take the South African case, in the 60s we had a big boom, industrialization of South Africa. In the 80s we had a big boom around the shopping center. because we didn't have the densities, we created shopping centers, and we told everybody to go to the shopping center, to drive to the shopping center, where there would be enough people to run the shopping center. And then we had good economic growth, 2005. The big issue is that if you miss the first one in a 40-year career, you've got a second one. If you miss both, I think you become a professor at UCT. And you start advising. But I'm saying the big issue which we are asking ourselves globally is what is going to drive this third boom, this boom that's coming our way. And I don't believe that looking at GDP is sufficient. Looking at economic growth in Europe will tell you part of the story. But I think that if you want to do well in this sector, you've got to keep an eye on the big structural changes that we see in this property market. And that really means keeping a close eye on, what I often say, STEEP, the social, the technological, ST, economic, environmental, and political, STEEP, STEEP. People use PESTEL.
Social, technological, environmental,
economic, and political, STEEP. So social, have a look at the millennials. What does a millennial want? I mean, for many of us, the idea that you would be happy to live in a 15 square meter flat. In fact, in many places in the world, they're 20 square meters, five steps by 4 steps. That's your flat. But it gets you into the right part of town. So social issues become important. Technological issues. I mean, the whole prop tech game. I mean, we saw that, the issues around that. When we went to a lockdown in this country, in South Africa, the deeds registry closed. And it sort of reopened, and then it reopened, but no one got back to work fast enough. Well, I would hope that that's the last time that we play that game, that from now on, we will have our properties on a blockchain technology of some sort, and that we don't have this. So and the point I'm making is that the property market itself, it's not the forces influencing the property, the way the property market itself functions is going to alter. Green building, environmental issues are going to be critical. Where we live, I think that we will see more commercial space in our neighborhoods. We may have walked out of here saying, you know what, working from home is okay, but it's not the greatest thing either. In fact, we all end up eating too much. We have this fridge in the office that is open the whole time, and you have big leisurely lunches, delightful. But I was happy to take my dogs for a walk yesterday for the first time. They thought I had abandoned them completely, but I think we will walk out of there saying, maybe if we can have satellite offices in our neighborhoods, which is one step away from our homes, maybe there are opportunities there. Do we all have to drive to one point? The salesperson who's in one part of town at 3 o'clock says, I'm not going back to the office, but if there was a satellite office, maybe they would. So where our real estate is. And then, look, the political changes, I think some of our municipalities, we're going to have to follow our municipalities out of this recession very, very carefully. And make sure they don't increase our rates and taxes to balance the books. Now, Scott, you mentioned the recessions that we've seen in the past and the global financial crisis in 2007, 2008. I think there's a difference at the moment for investors, is that this recession did not start in the financial markets. I think that the financial markets have generally got through this relatively well. This was a game that started in the real economy. In fact, just the opposite. In 2008, it started in the financial markets and then ended up in the real economy, employment, GDP growth. here we're in a slightly different style, which I think could work, possibly even if it's long, but I think we're getting out of this in the opposite direction. And we start with the real economy, where we've seen the shutdown of economies, and then watch what could happen in the financial markets. But and I agree, Scott, that we've been using monetary policy. Many governments have, although there's not much leeway unless you just start printing money, which is a possibility. Yeah. When the risk for inflation is relatively low, maybe it becomes an option. I know there are a number of articles coming through and viewpoints at the moment of the sort of helicopter view, which just says increase the money supply. But I think there's not much room for that. Fiscal policy, not much room, and certainly in countries like South Africa, emerging countries, there isn't much room. Once you start hitting debt at 85% of GDP, you've got your problems. So what's left? And I think what's left is for governments to create some sort of certainty, investor confidence in this game. And I would hope that we'll see that through public-private sector projects starting up. So where do you go in property? I am swayed a bit towards the residential at the moment. I think we'll be mopping up a bit of the commercial space in some of the markets. Although in Europe, we've been saying for the last year and a half that we're sitting at the mature side of the curve. That properties were in certain instances overpriced, but I carry on being amazed how that game has just carried on. And we don't seem to have seen a stop there. And yes, there's evidence that some property prices are going to come down. But I'll tell you one thing now, that people are going to be very reluctant to value anything in this environment. The valuations of properties are probably going to be kicked down the can. The can is going to be kicked down the road in the hope that you can value next year, or we're going to see some very regular valuations. Much more regular. We'll have to value now, and we'll value again next year in a very different environment. So we may see a bit of volatility in that market. Scott,
I read an interesting article today. I've actually got it to share. And it was something along the lines of, in America, people are making, way below market value offers, basically call them cutthroat, call them whatever you like. And in Britain, it was like, it's not proper to do that, based on everything. So it's just interesting of the different cultural context of how to deal with the crisis.
Yeah, look. I mean, it's been no easy game. The only thing I can say about this crisis for anybody, investors as well as anybody else, make sure that people want to do business with you after the crisis. And with that, I mean, especially in property, tenants who say we're not paying, banks who become hard, municipalities who don't come. I think everybody needs to come to the party. And I think if everybody comes to the party, we can walk out of this still being friends and wanting to do business with each other. So all I'm saying is make sure you walk out of the COVID-19 in a situation where people want to do business with you after COVID-19.
I think that's very very valuable advice. I want to just check. I've got some questions, but I just want to see from people that are here. So Gavin said, will the Wealth Migrate platform be offering pound and euro investment opportunities? Yes, Gavin, I'm going to talk about it a little bit later. But yes, we've got some exciting opportunities coming up. Will the slides be sent to the attendees? So mine can be, Linda, no problem.
Yeah. And mine, I'll make mine available, Scott. So.
Thank you very much. Jay said, would like to see the data on service buildings serving residential developments of all types, assisted living, serviced rentals, affordable housing, etc., including land services from regenerative agriculture to brush clearing and other property maintenance. Can research, though, respect your recommendations? Sure, it's quite a wide question. So let me just read this again. Would like to see the data on service businesses serving residential developments of all types.
Let me just respond to that. And actually, it's a very interesting question, because, by the way, Scott, do you want to take the other questions first, or shall I respond?
No, please fire away. No, it's brilliant. That's exactly what we want to.
Now, why it's interesting is this, is that in the past, property owners sold gross lettable areas, square meters of space. Off you went, and you could rent some space from me, bring your desk, and get your people and get them started. What we're seeing, and I think that's the point with serviced offices and serviced residential, is that we're getting to a world which is not unlike the hotel world. In other words, when I'm in a hotel for 2 nights, it doesn't cross my mind, or I certainly don't think of it in terms of I'm going to be renting 20 square meters for 2 nights. That's not the way I think. I think of the service that I'm going to get there. And that's why I'm willing to pay more at a 5-star than at a 2 or 3-star. And I think what we're going to see in the years to come is that property owners will start acting more like hotel groups. In other words, you'll be making your money to a large degree from the services that you provide, from the experience. In other words, you are going to be selling a service, not square meters. And I think that's an important difference. You know, when you're in town, you can be on the same street and you've got a Hyatt hotel at one point, and you've got a Holiday Inn down the line. They're in the same place, but at very different price points on the service. So I suppose what I'm getting to is that we're, at the moment, your property owners is allowing the, let me call it, the WeWorks of this world to provide that service. And I think we could very well find ourselves where property companies start providing that service. I mean, how many of us have been in a hotel where you've said to yourself, oh, I could actually live here. I quite like the idea of being in this place where somebody does my bed and cleans my place, and I'll go and eat downstairs and be fed and looked after. This appeals to me, and that's the typical co-living environment where you're not buying into the real estate at all. You are actually buying into the service. And of course there's square meters behind it all, but it changes the mindset. So I hope that that's what the question was asking. I see there was an agricultural component to the question, but I think maybe we'll just leave it at that.
Yes, I think the question was, if I can understand it, it was also asking about if you've got residential developments, all the services that are around it. So, you know, like actually sort of assisting, you know, I don't know, like, I mean, even, yeah, it's a very broad question, as I said, so I'm not quite putting my finger on it. So, Jane, if you want to tighten up the question, let us know as well.
Yeah, but you know what, if it is the services around it, the other thing to bear in mind is that if you're going to live small, 20 square meters, the services that are around you are going to become absolutely critical. You'll argue, I'm happy to live 20 square meters, but I'd like to have a park next to me and coffee shops and stores and so forth. And there's some really interesting concepts coming through the whole way from go and live on a farm where a farmer will look after the place and you live. So instead of a golf course, very different communities, agricultural communities where you can go and live. Absolutely.
So Nikki said that in terms of replacing a tenant around vacancy, it all depends on the turnaround time of your location. So the location of the property determines that. And Fritz has got a question here. He said, Professor, why do I find within my networks that financing seems to have dried up in the South African economy as opposed to what it should be due to explanatory monetary and fiscal policy? It ties into the slide Scott shared with us before, indicating the M2 money supply versus velocity of that same money supply as it relates to quantitative easing.
Look, it's a good point. And I think that the financial sectors at the moment are managing their books largely. I think that there's risk in the game at the moment. The other thing is, which you also have to watch out, is that you can increase your money supply, but there's no guarantee that investors are going to take it up, and especially in the South African environment at the moment, it's not said that investors are going to take up much debt in this environment. So I think that you've got to be very careful. I think what the monetary authorities are doing to a large degree at the moment is they're buying up government debt. They are the investor of last resort on treasury bonds. And by bringing the long bond rate down where I think it was at 12% at some point around there in March, by bringing it down, it's made money cheaper for the public sector. And I think it's largely playing that role at the moment, rather than accommodating the debt requirements. But I think I've played quite a role in the last few weeks trying to reopen up the real estate sector. There are going to be a lot of investors or smaller investors who are going to have to readjust their real estate holdings. Can you imagine if you are somebody, in Cape Town, there are about 10,000 Airbnb flats. Can you imagine what those investors are dealing with at the moment with the short term? And the sector has opened, but it doesn't allow you to extend leases for short-term leases as Airbnb. So yes, monetary policy is one thing. Like I said, I think that the monetary authorities are accommodating largely the public sector at the moment, and they're managing their books.
There's just while you talk about the South African industry, if I share here, I got this just today. In terms of the restructure and possible job cuts at Pam Golding, because of the within the industry, you know.
Yeah, look, I mean, this is an industry, anyway, I'm not going to go into details, which was only going to open up at level 2 in South Africa, which is now going to open at level 3. And I don't want to go into the estate agency business, but some numbers that I've just been looking at, by the way, is that about 70% of all the properties in the deeds registry in South Africa, by the way, are priced at around 800,000 rands and below. So you can imagine that when you think you're looking at the property market, you're looking at a small part, and properties of $1 million and below have shown capital growth of about 13 to 14%. So I suppose what I'm saying is, yes, this is Pam Golding. But I think in that same article, which I read this morning, I think, the strong point is also being made by Pam Golding that they're going to have to restructure the way that they do business. I think that with the new technologies and that are coming our way, I think that the estate agent business as we know it is altering. So yes, it's the economy on the one hand, but I think there's some deeper issues that one wants to bear in mind.
If I was to ask you, in terms of your STEEP, so your social, technology, economic, environment, and political, what would be one, if I'm going to ask you a Clem Santa question here, you know how he talks about flags, and if you would say, what is the one flag that would be an important flag for each one of them? So what is the one social trend? Because you mentioned earlier that we as investors need to really focus on where the long-term trends are going. And so if I was to take STEEP, what would be one major trend per each one of those categories that you think people should be watching?
Okay, so first of all, it's difficult to lead me to one. Maybe I'll give you two.
Give us the main ones then as to what you think.
Okay. I think the first in the social trends, it comes back to a point that we've been discussing, and that point comes around co-living and co-working. And I think that it's the way that we're going to use space socially, which is going to be important. By the way, I don't like the word social distancing. We need physical distancing But like what we're doing now, we're socially together. We're not socially distancing ourselves. We are physically distancing ourselves. So we need a lot of social getting together, but maybe we're not physically. But so I think the first point is around that. It's about co-working, co-living in the social environment. Then in the technological view, I know that some have argued that blockchain technology maybe hasn't moved as fast as we thought it would be, but still, I think that we are under the COVID-19, we may have accelerated our technology where we thought we'd be in 5 years' time. We may have accelerated that to the next year or two. So I think we'll see an acceleration of the number of the trends that we have seen in the past. And whether it's crypto properties and others, I think people would be more open with that. Economic, if I can take economic first, I think that the relationship, certainly, and I, being a property economist, I tend to look more at property. I think that the correlation between GDP and space will probably break down. Where in the past we had these econometric models which said, well, economy grows by X, we need X amount of space. I think we probably won't be able to count on that. And I think that, again, the form of the economy starts altering. Even if the GDP grows, what the economy looks like becomes the important. Environmental is very much with us, and I think the main issue there is still going. It's still, but again, these are not short-term trends around transportation. If I were to look at what is going to cause the next upcycle of the property sector, I think that public transport, densification, and everything around it will do well. I mean, even if you look at the moment, I can show you some graphs. I mean, community shopping centers are performing much, and neighborhood shopping centers are performing better than regional shopping centers at the moment. And I think that's a reflection of our densities. So the economy, and so from an environmental, follow the public transport routes. Maybe not circular, the linear routes will play an important role. And then political, I think that the major political things that we would look at, certainly from a property perspective, is local government. You know, it's the tier of government that we tend to deal the most with. And so I'm not saying pick your cities, but I think where it could become interesting is that cities a bit further away. Again, let me take the Cape Town where I happen to live. Suddenly Wellington, Paarl, areas 30 kilometers suddenly become more interesting, where you suddenly say, if I can be away 3 days away from work, if I can operate, do I really need to operate in an expensive place in the middle of the city? Can I actually move out to a smaller town and go and live there quite happily?
There's me living in Knysna.
I know. You know what? As I was saying it, it crossed my mind, Scott, that you're sitting there with your beautiful fireplace in Knysna. But I think it shows that we may walk out of this saying that it's actually possible. It's actually what cities we live in, where we want to live, cities that perform well, become quite interesting places to go to. And so I think that politically that becomes important. Look, in the short run, governments are going to have to get these economies going. And again, I think the construction sector still has an important role in getting these economies going. I'm doubting a bit of monetary policy at the moment, the effectiveness of monetary policy in this environment. And like I said, in many places of the world, there's just no leeway. I mean, once you had negative rates or 0.5, I mean, how much leeway have you? You can still go with a bit of quantitative easing. But the issue is also, even if you do that, will it make a big difference as far as investment is concerned? And that I'm not convinced about in this environment where you have fairly low investor confidence, certainly in the last few months, whether it will have the impact that we think it will.
I just want to show you something quickly. I'd love to get your comment on it. Just before, there's two great questions here, and then I'll look to wrap up. But this was a slide I actually created in 2015, and it was about sort of internet adoption. And you can see on the left-hand side, you've got consumption, participation, transaction, and ultimately investing. And then at the bottom, you've got time. And it pretty much is all along the lines of, people have consumed publishing, and then social media, and now e-commerce, and we're finally going into this final stage, which is actually online investing or social commerce, which is where e-commerce and social media come together. And what it's so interesting, because you spoke about blockchain and other acceleration of tech, and I mean, these are literally slides I've been showing people where Zoom's gone from 10 million users to 300 million users, and the JSE's done its first virtual AGMs, and yet some of us have been living like this. I mean, it was interesting. Our business didn't skip a beat because everyone works online anyway. And what I tend to say to people, and you've got the adoption curve of anything. So in any new technology, anything new, there's an adoption curve. And you've got people like me, and I tend to use cell phones that like to try stuff because it's new, it's pleasurable. So I got my first phone actually the year I left UCT. So 99, I got my first phone, and my mom was like, it's very extravagant, and my logic was, well, it's cool, it's a cool gadget to have. And nowadays, people have phones, literally the laggards have phones because they can't connect with the world, they can't work, they can't do anything, and they often move towards it because of pain versus pleasure. And what's fascinating is that psychological research shows that people move 4 times more away from pain than they do towards pleasure. And
absolutely. We're very risk averse.
Okay, sorry.
No, we're very risk averse.
Yes. And it's just interesting because I'd love to know what your thoughts are around sort of this whole adoption of technology, online investing. I mean, you talk about estate agents. There's good stories in Australia where people actually went online and did virtual tours and actually sold online, and it forced them to go online.
Do you know, Scott, there's one thing, and I'm seeing it even in the property story at the moment. We've seen some failures, even in the prop tech environment. And I think where people make the fundamental mistake is that ultimately it's still about people. God, you can use all the technology you want, and we can, but they want to interact with Scott. They want to interact with somebody. And I think that what has happened is that we've had people in the tech game where we've allowed, with the greatest respect, the techies to take it over. And suddenly you've got the techie there who just hasn't understood that ultimately the investor actually wants to see a broker, or actually wants to have somebody there. These are big investments for many people. And it comes back also in the behavioral economics that I'm involved with. Somebody like you, I mean, you've been in this for many years. Yes, you got the data, but you got your intuition as well. And that is what you can't buy from the Excel spreadsheet. The Excel spreadsheet will give you the numbers. And often they're important. And in certain cases, I've been long enough, they are required to justify whatever decision one takes. So I'm certainly not, and that superb book, which I urge everyone to read, Thinking Fast and Thinking Slow, the book by Kahneman. And it's been a bestseller for years. And the fundamental issue he makes is that when you make a decision, you've got your level 1 and level 2 thinking. Level 1 is especially when there's too much information. For example, deciding who your boyfriend, girlfriend, or your wife or husband is going to be. Don't use an Excel spreadsheet for that, right? There are too many variables in life. You can't put a model together that will tell you whether you'll be happily married or not. You go with your intuition, right? At some point, saying, this is the person for me. And you go for it. And many of us make right decisions or wrong decisions. So what Kahneman says is level one, intuition. When there's too much information, follow the expert, follow the people that you follow. Your medical doctor may not be the best medical doctor in town, but it's the person you trust. Level two thinking says, be careful. You can have biases in your intuition when you make your investment decisions. Go and do some homework. Think carefully. That's your level two. Calm the game down, get some numbers going, and that they both have a role to play. There's much when I teach modern portfolio theory, capital asset pricing model, and other things at the University of Cape Town. I spend half of my time teaching the numbers, and I spend half the course doing behavioral finance, saying, look at the numbers, but there's a lot that the numbers can't explain. There's a lot, the lemming mentality we had in 2007, 2008, the numbers couldn't explain that. Some pricing we can't explain. But maybe by understanding a bit of the human condition in our behavior in the investment world, we can maybe make some better decisions. So it's finding the balance.
It's so interesting what you say, because that webinar last week, where people were talking currency, it actually is, he talks much more about behavioral, basically the way people behave, and that, it's got far more to do with sentiment than actually to do with, whether the finance minister's fired someone, whatever. And it's really interesting. And then the other thing that I find interesting is that sentiment has long-term trends, and even though it might have ups and downs, it still follows a long-term trend. And as an investor, it's really important to understand those long-term trends as well.
Yeah, and you got to have people who you need to believe in. And I think that's it. You believe in your medical doctor. You believe in, you've got to believe in people.
Two last questions here, Prof. The one is, it's a bit of a comment, but an interesting one from Derek, where he's gone, the way forward is ethical opportunism, helping those in trouble from homeowners to multi-family owners. So I haven't actually heard that before, but I presume what he's saying is that if people get themselves into mortgage problems, we ultimately help them combine and they become multi-family owners together. I don't know if you've come across that before.
So what are we saying? So sorry, I'm just trying to understand this. So you would have an investment where you bring in other investors into your property, huh?
No, I think what he's saying is ethical opportunism. So it's where, say 10 years ago, where we had the global financial crisis, a lot of people lost their houses where they got repossessed. And what it's saying is bringing finance, but where multiple people invest in those properties. I presume that's what he's saying in terms of the comment.
Yeah, and I mean, and that is becoming quite a popular way internationally, especially, and I tell you, yes, it's distressed properties, but you have a lot of millennials at the moment who are saying, I want to be in property, but I don't necessarily want to be in my property, invested in my property, because I need the fluidity. So whether it's and if this is what you're getting to, between crowdfunding and other means, I think there's increasingly opportunities for investors who will need to liberate a bit of liquidity to say, let's go and find others to participate. I think that what is also happening, and this is what concerned me about not having the real estate sector open, is that we have people out there who have problems with their businesses, who are going to have to try to leverage funding on the back of their properties. Ultimately, it may mean finding investors. So what I'm saying, instead of running to government, to try to sort that out. My argument was open up the property market as quickly as you can to make it possible for households to rebalance their balance sheets.
Well, that's fascinating. Well, if you know any like that, let us know, because that's exactly the point of our technology platform, is allowing whether it's millennials or other investors to be able to participate. Nikki's got a question here, and I think let's maybe call this as the final question. But she said, would it be better to invest in Europe and the UK rather than the US because of the possible deterioration of the US dollar?
Again, I saw what you were saying as well, Scott. I mean, the graphs that you were showing. I'm taking a bit of a concern on the US dollar at the moment. Yes, it is. It's a significant currency. I think that we're going to see important changes in the global financial world. I think to some degree globalization has died a bit in the last months or two. I see China coming up. I see the renminbi strengthening in the story, and at the moment I would put a bigger bet on Europe than on the United States and the dollar. So I would be quicker into the euro. But again, I must say that I'm not a currency specialist in any form. I tend to look at it more from a real estate perspective and say, are you better off with your leases in dollars or in euros? Anyway, that tends to be my perspective.
No, brilliant. Well, listen, Prof, I really appreciate your time. It's been wonderful having you, share tonight. I know that you and Alex spoke today, and it was very impromptu. So, I really just, firstly, thanks, Alex, equally for reaching out. But it's so interesting to get your insights on the market, and it's interesting even how much has changed and also how little's changed from what you spoke about 3 months ago. And I think that's really important for people to. I know not everyone was sitting in the room, and we work there in Rosebank and in Cape Town. But the point being is that it's I can tell you, Alex was there as well, where it's a lot has changed, and from what you're saying, those long-term trends are still on pat, if that makes sense, on course.
And I think Scott, I think you're making the fundamental point here, and I think we've got to be very careful not to be overly influenced by the COVID-19. It is important. Some economies will take some time to get out of this, but I would say hold the course on the long-term trends. I think that, like I say, if anything else, maybe the ship will go a bit faster, but I wouldn't be shifting on some of the longer-term trends that we've seen. The only issue is start thinking very carefully how you think about China. I think China could walk out of this in a much stronger position after COVID-19 than before.
Oh, brilliant. Well, thank you very much. And Derek's come back and said that the ethical optimism came from Jay Abraham, and basically it's saying that it's okay to profit from this crash as long as it's done ethically. People have problems and are staring sequestration in the eye. It provides the opportunity for us to help these people by buying their distressed properties. So that's what
absolutely, and I think that and there will be, and for a lot of people to carry on with their businesses and to reopen their businesses, they will rely on investors coming into their real estate. And I think that if we can keep businesses open and small businesses by playing a role, I think it's an important social role that the private sector can actually play in this.
No, awesome. Well, if you don't mind, and you're very welcome to stay on, Prof, what I'd like to do is I want to pivot. I had some slides that I wanted to share about Europe and just actually some deals that we've got coming up on the platform. But as I say, if you need to duck, I very much understand.
Well, I'm going to stay for a while because I'm quite interested in hearing what my former students have to say about the world. So.
I hope we, what's the word called? I hope we impress. So just as an example,
Sorry, Scott. I just wanted to say thank you very much for the professor for joining us this evening and engaging with us. It's been very, very valuable. My A4 page here has been completely filled, and I'm very excited to watch this webinar again and actually learn more. And hopefully this is not the first. This is the first, but hopefully not the last. So yeah, I just wanted to add that. Thank you.
I do.
Thank you. And there, maybe between the two of you, you've got a dissertation here. Huh? But no, look, it was a great pleasure. I hope to interact also. I feel a bit on these programs, a bit like a radio presenter. You know, I'm not so sure who's exactly out there, but I suppose that's the syndrome of a radio presenter as well. You know, you don't know what people are doing or where.
Well, sometimes I'm on webinars and I can't even see anyone. I'm just talking at my webcam, and that's it. Like you're just entertaining yourself, basically. So.
Good.
But I wanted to, and it's so interesting, Mark Lubina has come back here and he said, finally Germany, because Mark's been on my case for the best part of 10 years, saying, you know, why not Germany? And it's really interesting. There's a group called Calio Capital that we did events with in November and in March. And they're a family office. They look after 85 of the wealthiest South African families and American families. And what was fascinating is talking to them and talking about where the world economy was going and currency and everything else. And they said, well, we're really strongly looking at Europe, and specifically when it came to Europe, Germany. And so I actually asked them, and I said, listen, you know, why Germany? And I can share the slides with you, and I just highlighted some of the points because they wrote me a whole long text. But Germany must be seen as its own investment thesis. It is the strongman of Europe and seems far less brittle than other countries on the continent. Germany is a very powerful economy with deep industrial base and financial infrastructure. Although the country is home to some of the world's great corporations, it also has a huge base of medium-sized, often family-owned businesses. For the past decades, unemployment has been low and the welfare system strong enough to keep the home occupancy and consumption alive. And then this one I found really interesting. Geographically and business activity, population and hence property market activity, including buying and selling of assets, financing and leasing, are far more spread out across the country than in other places. So, you know, if you take Australia, it's got maybe 5 or 6 cities. If you take England, same sort of thing, and even sort of one major one in London and Paris, etc. And one of the things we always liked about America was it had many, many cities all over the place. And Germany has a large number of cities which are investable and which have their own meaningful businesses and/or employment catchment areas for major business. Many internationally known German brands are often headquarters in what would be considered secondary towns, which I found fascinating because, you know, we looked at some of the opportunities and there were cities we didn't actually see. The above means that there's potentially different approach to markets that avoids the competing for trophy assets in concentrated towns. So again, something we liked about America that you didn't get in England or in Australia, because with very few cities, everyone's fighting to get the best asset in Sydney or London. You can do great leasing deals with with strong tenants, which might be from an outsider's view seem like secondary locations and still have deep enough market to relet if necessary. With a deep financing market, including local asset-hungry banks, interest rates are low and liquidity is plentiful. Property yields, particularly in the secondary assets, have been far higher than the cost of debt. In the asset class, this deal falls in what we expect the yield range of 5.5%, while debt is priced all in at less than 2%. So to give you an example of what we're talking about, and this is a deal that they actually did in February, and it's effectively they bought 3 German retail shopping centers, not shopping centers. So if you think of it like hardware stores, they're located in secondary cities, so it's exactly what they're talking about. And 89% of the rental is owned by a company called OBI, which is Germany's leading DIY retailer. It's got a strong covenant. They've got 351 stores in Germany and over 300 elsewhere in Europe. So they're massive, basically 6.4 billion euros.
By the way, Scott, if I can say that business, and I know for a number of reasons, I know it quite well, the OBI. They have done a roaring business in the post-COVID environment. Once these markets opened up, they've been performing particularly well. And they are probably the best DIY. They're also in Poland and Austria and a few number of other places.
That's fantastic. I'll remember to pay you your bribe afterwards. I'm joking, Prof. but what's really interesting, which I found, is obviously in any retail, everyone's worried about e-commerce, whereas in the DIY sector, you can actually see the percentages here of the impact of e-commerce in the sector. And I tend to think to myself, if I want to buy a drill, do I buy it online or do I go to Builder's Warehouse as an example? The lease terms are 5.3 and 8.2 years, with the intention where the rent is only 6% of their turnover. So and you can sort of see they're called big box DIY in terms of it. And then what's quite interesting is that the partners on the ground are Encore, and formerly led by the directors of the Redefined International PLC Group. The current debt has 60% loan to value, 1.7% per annum amortization at 2.5% per annum, and refinance options. And what I did think was really interesting is that they're looking to do extension of the leases, which would actually increase the cash on cash returns closer to 9%, and also looking to roll over the current debt. So what does it mean for investors? Well, the base capital cash on cash is 7%, but expected to increase to 9% over the life of the transaction, with IRRs being in the region of 12 to 14%. So I just wanted to give you an example of a existing German income producing deal, and certainly one that we are aggressively going through due diligence at the moment in terms of what we wanted to. The other one I wanted to show you, which was really interesting, that I sat on this webinar yesterday, is that this company, CA Ventures. So CA Ventures is a $14 billion company. They're based out of America, England, and Europe. And if you look here, they're 25% international. So they started in America, 25% student, 32% residential, 16% senior living, and 5% industrial. And you can actually see in terms of the breakdown of who they are, the different areas that they're in. They've got 1,300 staff. You can see that they started in 2004, headquartered out of Chicago, and ownership of 185 assets. And sorry, it was 1,400 employees, not 1,300. And what's really interesting is that they are very active in Europe, specifically in the student living. So one of the deals that they have come to us with is a deal in Dublin. So in Ireland, Dublin, and it's a 12% return with 6% paid annually, or basically paid quarterly, but 6% a year, with the remaining 6% plus the capital growth on the back end. It is a growth opportunity, but there is an income during the growth period. And you can actually see, there's a huge amount of information. One of the things we love about this partner is they're also looking to bring medical office. And we've got a long affinity and track record with medical that they're also bringing to the market. So just to give you an example here, if you look at their entire pipeline, there's so much information, I'm not going to share all the deals with you, but they've got a whole bunch of pipeline coming up in the UK, in Italy, in Ireland, in Spain, and the Netherlands. And the one that we're looking at the moment is specifically in Dublin, as I said. And then the last one, which is what we call a growth opportunity. And this one, ironically, I was sorry, I got the webinar thing wrong. I was on the webinar to this one just yesterday. And I love the way the guy stipulated it. He said it's the opportunity to invest in one of the best locations in the world. And if you look here, you've got Buckingham Palace over there, and you've literally got St. James's Park here, and that's the building right there. It's an office refurbishment. It's a freehold corner location, literally one of the landmark buildings in Westminster. It's again a major partner on the ground, and who's done many billion euros. Started in 2005. They manage over 700 million euros. And what the opportunity here would be that they actually have a government tenant from now until January. So they've got a government tenant paying the rent. They will then spend about 4 months redeveloping the opportunity, and you can actually see the exit strategy over here. Yeah, this is it. So they're looking to buy it for $24 million pounds. Sorry, 24 million pounds. There were actually offers pre-COVID at 26 million pounds plus, but COVID's been it's enabled. There were 45 other investors that have all left the opportunity, and these guys have actually secured it. And there's 3 different exit strategies. One is the base case, which is where they build it and hold it. The other one is the single let, which is where they get an office occupier or a long-term lease with the school they're talking to, or where they sell it directly to a owner-occupier. And you can see here in terms of the IRRs and the investment returns, you're looking at about 20%, or somewhere here. Can't remember where it was. Here are target returns of 15 to 20%. But I think what's important here is that these are not, there's no income. So it's what we call a growth product, where you invest and look at it. So there's 3 different opportunities that we've got coming up in Europe. I did find some other slides that I just wanted to share with you. Sorry, not slides, but so this for me was pretty interesting. So BlackRock has just reached its hard cap for its latest European property fund. It's literally closed last month, where they've just raised another 1.3 billion euros for their European investments. And then this is a Wall Street Journal article, which I'll share these links with everyone who's here. And it talks about the different markets. It talks about London and how London was actually being pretty hardly hit before COVID, and then COVID's given it a real knock. And this is actually where I was talking, I found it quite funny here, where people said that it was not polite in England to lowball offers. It was somewhere here in this article. What I did find as well very, very interesting, What I did find very interesting here was in Germany. They were talking about the German market, how well the German market had actually been doing, and how it was the best performing market in Europe in 2019, according to Savills, in terms of the growth and the demand for income, etc. So there's quite a lot of talk here, and this is obviously in the residential market around what's happening in Germany. And just by the way, this article has all the different markets between Spain, Austria, etc. Then how global property markets are covering since COVID-19 and where the opportunity lies. And it's quite interesting, another great article here. But if you go down to it, there's literally there's 7 things to keep in mind. Don't try to time the bottom of the market. Weigh the risk of buying without visiting. If you're an experienced global property investor, look to taking advantage of the current situation. If you find something you're interested in but are uncomfortable pulling the trigger, you can ask for a long reserve time pending a site inspection. Go for premium properties in premium locations. Buy luxury where you can. And they said 7, but there's only 6. And then finally, steep decline in European real estate investment indicators point to a sharp COVID downturn. And this was way back early in May. But again, another article just looking at the different markets, but specifically in the retail sector. There's a big UK investor where many of the South African funds have invested that have done extremely badly, and that has nothing to do with COVID. It's because shopping centres in the UK are not performing anymore. So, it just gives you an idea of some of the things that are, from a practical perspective. What I'd love to do is chuck up a poll and see what people think in terms of the different opportunities that I've mentioned. And I'm just interested in what people are interested in. From our perspective, the one thing I love about COVID is a couple of these partners, all 3 of these partners are massive partners. They do extensive due diligence. I would love to be able to partner with all 3 of them. And 3 months ago, well, basically for a year, we've been trying to partner with all 3 of them. And suddenly COVID comes along, and it actually provides us with an opportunity to be able to invest as investors alongside them with extensive big partners and them actually doing the due diligence as well. So it's interesting. Yeah, I can see 20% of people have voted. I'd love your vote. Just give us your opinion on the different markets. So you can see there the London property. So that's the one in Westminster, the growth opportunity. The DIY big box is the OBI one in Germany. The aged care in the UK, obviously we've spoken about before. The student accommodation in Dublin, I've mentioned, and then the medical in America. Most of you have been online. So I'll give that another 10 seconds or so. As I said, I'm fascinated on what people are thinking. Okay, so let me close off that poll. And just to really clarify as well, I think one of the things that's so exciting now with our digital global wallets, your money is protected by European law. And whether you want to invest in pounds, in euros, in dollars, in Aussie dollars, you don't have to choose anymore. You can literally do it all in one place. Whether you want to invest in property or private equity or structured notes, all your returns and everything come back into one place. And we did have a session live at lunch. And if people do want to stay on tonight, Alex will actually create a Zoom room and actually sit with anyone that wants to go through it and get going. It really is a game changer in terms of property. And equally, Prof, I don't know if you're still here, but something that's also a game changer, which people don't realize, is that if you buy a house in London and you're earning, I've got a house in London that makes me about £1,000 passive income per month. So it makes me about £12,000 a year, which is good money. It's not a small amount of money. But the difference is that I can't reinvest the £12,000. I can't buy anything in London with £12,000. Whereas now on the platform, with as little as $100, you can reinvest. And so they often say the biggest problem with property is you can't compound your investments. Whereas now with technology, you actually can.
You can, yeah.
And it really, it's a game changer for people's returns, So, where people used to have to invest from $100,000, then down to $10,000, $1,000, we're really excited. We're now helping people invest from $100, and we're well on our way to our dream of getting it to $1. How does it work? Well, in simple terms, we go out and we find a trusted partner. So in this case, it's a medical operator in the US. We find the partner. They go and they find a deal. So as an example, on our platform at the moment, we've got Medical 27. You and I come along, and there's 4 simple steps. We can sign up on the platform. We can select an investment. Remember, we don't give financial advice. We give you the information to make the decision. You can transact online, and you manage everything in one place. And so, what used to take months or years, you can now do in minutes, and you can get access to quality partners. As an example, to Mark's point, I've never invested in Germany before, because quite frankly, I don't really know Germany that well, and I've been there on holiday a couple of times. But now we've got partners that have extensive knowledge on the ground there, extensive due diligence, and that's what I like. It's about finding the right partners within the niche opportunities.
Scott, yeah. And you know what? There's an increasing view out there that Merkel may have been quite right to bring 1 million Syrians into Germany, because most of Europe has got a population that is getting older and older. And suddenly Germany has managed to bring in 1 million well-educated Syrians and others from the Middle East to underpin the economy. And history may well have proven her right in that respect, that to keep that economy growing, you are reducing the risks which some of the other countries in Europe have.
Yeah, no, it's fascinating. The last comment I just wanted to mention to people was that there's a way of investing that I found out and has been used for centuries, and it's called collaborative investing. And really, it's about finding local partners. So you don't sit in South Africa or anywhere else in the world and say, I know everything, I want to run around the world and try and make all the decisions. You find local partners who have local knowledge in those markets. The second is you need to get them to invest. There's absolutely no point in you taking all the risk and they don't invest. The third is you need to get them to believe in the model. So it's a win-win model. The fourth is you need to conduct regular meetings. And the fifth is that there needs to be two-way communication. And this for me is where technology becomes so valuable, because it becomes so much easier than it used to be 10 or 20 years ago. And it's where platforms can really do this. Now, again, in the past, you needed millions, billions of dollars, to be able to do this. Whereas now with technology, we've got smartphones, we've got smart TVs, we've got smart fridges. Why can we not have collaborative smart investing, which is really what we try and do in helping people know where, when, what, who, and how to actually invest. So the last thing I wanted to mention to you was something we're very excited, which we're going to be launching next week actually, is our wealth diversification portfolio. And when we were at our events in March, actually the last time that I saw, Alex and I saw the Prof live, was we were doing a roadshow that same week. And what was interesting, the number of our clients were saying, listen, the world is changing. What about diversification? And so we said, well, why don't we bring it all together? Why don't we bring a solid performing sector in Europe, niche commercial? So the idea is to bring that OBI opportunity, bring aged care in the UK. So you've got a euro investment, you've got a pound investment, bring a structured note, which takes advantage of the stock market, but provides a fixed return within the stock market. And we're considering at the moment pounds and euros, or possibly euros and US dollars. We're just looking at the returns there. A private equity in a global growth company, and through the global growth company, a private equity investment in a Chinese technology company. And ultimately, you allow an investor 6 assets, 5 partners, 4 countries, 3 continents, 2 currencies, and 1 result. which is the diversification, the income, and the protection. So, what I say to investors is that if you go back to what Warren Buffett said, protect your capital is the number one thing. Earn a cash-on-cash return during these times, and be able to get advantage for it. And the nice thing is, again, you can do it all easily, simply in one place without having tax or structuring or anything set up. And so, just to let people know, these are going to be the different levels that people will be able to invest at. In that, it is a slightly more sophisticated investment, so we won't be able to get people in at $100 or so, but there will be slightly higher minimum investments. Where people will be able to participate in the other deals. As an example, today is WealthE Wednesday, and you can participate from $1,000, and/or you can invest in the starter pack and get going from $100. But for the wealth diversification portfolio, there will be higher minimums. It is starting on next week. And what is interesting, if I share my screen with you quickly, is that if I go back to this slide here, I had it for you here. You can literally go to this link. So we'll put it into the chat box, or if you're watching the recording, you can click below, and literally you can download the fact sheet. It's a 3-page fact sheet. You can just register your interest. It hasn't gone live yet, and it talks a little bit about it and what you need to know, etc. So we're literally in the process of finalizing that. We just needed to tie up the due diligence on a couple of the deals, and it's interesting because Germany is the stats have just shown us that people are interested in Germany, but Germany was way the front leader there, and it's the front runner that we're wanting to put into the diversification portfolio. And really, with Alex and the team, it's all about talking to our team members to understand what it is you're looking for. And as I said, if you're watching the recording, click below. So to finish off, money won't create success. The freedom to make it will. And really, from our perspective, Prof, what we're so excited about is that with technology, often in the old days, to get into that OBI project, as an example, you needed €1 million, otherwise they wouldn't talk to you. And I didn't have €1 million, and therefore I couldn't participate. Now anyone with much smaller amounts of money is able to participate and to build a diversified portfolio, which is what we're so excited about. And so, my advice to anyone tonight, and I'm not giving you financial advice, but my advice is that if it is something of interest to you, chat to one of our team members. Alex is online tonight and supporting us and here to help. If anyone wants to, jump in on a Zoom room, are we going to run a Zoom room, Alex? In terms of if anyone wants to sit with you and run through, any of the setup, etc.
Yeah, no, I'm available. Anyone that has any questions or would like to chat about the platform or any of the next steps is more than welcome to come join me in my room.
Great.
Thank you, Scott, and thank you to the team. Fascinating evening that I had, and thank you very much for inviting me. Bye-bye.
Awesome. Thanks so much for coming. We really appreciate your time. Have a good evening.
Bye.
Just while Scott is running that poll that's currently up, I have put Alex's Zoom room in the chat box, so please have a look, and directly after the webinar, Alex will be in his Zoom to assist you with any of your investment queries.
Perfect. Thank you very much, Lee. So I can see the poll is up there and how many people have voted. We're up to 31%. So I'm always just interested in what people like in terms of different opportunities between fixed income, structured notes, private equity, and then the blended. So the blended investment we're actually calling the wealth diversification portfolio, which allows people, to be able to get a bit of everything, where you're getting it. So my suggestion is that I don't know, Alex, if I've got the right room here. So please tell me if I do. Is that your Zoom number?
It's 76628288743. That's my Zoom number.
Okay, hang on. I'll get it up there quickly. I see that my slides have jumped away. What was it? 76?
766.
66, yeah.
2828743.
2828743. Is that right?
That's right, yes.
Great. So, and just by the way, this will probably be one of the very last webinars on GoToWebinar. It's a sad day for me. I've been using it for 12 years, but it's come to the end of its sell-by date. And so we'll be moving across to, I think, Zoom permanently. But for now, if you want to jump over. And then my suggestion is, Lee and Alex, is that there's a couple of questions and stuff here, but I primarily wanted to just run through some of the education stuff and what people could get from the starter pack and joining the inner circle. But if people do want to jump over, Alex, to yourself and start talking about the deals or setting up KYC or funding the wallets or anything, my suggestion is that this is the pivot point. I'm not going to add anything new that people haven't seen already if they are previous clients of ours. More for new clients, I just wanted to explain what it was, what the inner circle was, what the starter pack was, and how they can get value from it.
Right. Thanks, Scott. Thank you very much. And thank you to all our online viewers. And I'll see you guys inside my room.
Awesome, Lee. And well done, Alex, for organizing the Prof tonight. Fascinating inputs from him. Really interesting.
Thanks, Scott.
Excellent. Lee, are you happy for me just to crack on? I only need 5 more minutes or so. I'm conscious of the time as well.
Yep, absolutely.
Okay, so let me just look at it quickly. We ask people, what are you doing to be a global citizen? Are you ready for 2020? And I think we all tend to joke with each other. It is a little bit more than we were all expecting. But there's 6 things investors need. They need belief, they need knowledge, they need access and investment, they need a system, they need support and accountability, and ultimately they need results. You can decide to do it all on your own, or you can actually do it together. A bird flying in a flock can fly 70% further than a bird flying on its own. Deepak Chopra says that if you try and achieve a target on your own, you've got less than a 50% chance of succeeding it. If you do it with a business partner, a husband or wife, you've got a 60% chance. But if you do it in a like-minded community, you've got a higher than 70% chance of succeeding. And that's why we created our Wealth Inner Circle, so that people could literally not only focus on the investment, so the right-hand side, but they could also get the education, they could be part of a community, and it could be about purpose. And so for 12 months, you come on a journey, you're part of the community. We have webinars like this, live webinars, we have WhatsApp groups, we have Facebook groups, and the whole idea is for people to be able to interact, grow, learn, and invest. We tend to say real people, real stories, real investments, all in real estate. We do have the eWealth Pack. There's a huge amount of value which is in the eWealth Pack. We've got our investor test. I don't have time tonight to talk about the 5 paradigms of fundamentals of investing, but ultimately you'll get a 26-page report. It takes you about 20 to 25 minutes to fill in the investor test. By the way, you can't fail it, and it'll tell you where you are. So it's your own personalized path, and then depending on where you are, it'll tell you what to do next in the 5 different paradigms. We've got online micro degrees, and for those that are interested in the eWealth Pack, that if you've stayed this long tonight, we want to add value to you. So you can literally go to the online link and get the eWealth Pack. In that, you'll be able to get access to the investor test and also my book, etc., which is in there basically. And just to finish off, we've also got a more advanced course which we call the Wealth GPS, which are the 10 steps for those that are at intermediate to sophisticated and want to go overseas, want to understand how to build a globally diversified portfolio, want to understand tax and structuring and currency and everything else basically. And every single part of this process, we recommend talking with a wealth consultant. They're there to hold your hand. I see it as like a private banker, someone who can actually really add value to you. And then lastly, what we find with people is that sometimes they say it's a bit overwhelming. What do I do next? So we created the starter pack, and it actually has got everything. So it's got the inner circle, it's got the eWealth Pack, it's got the micro degrees, the accelerators, it's got the wealth consultant, and it also gives you a $100 voucher. So although it's worth a couple of $1,000s, we actually give it to people for literally $197, and $100 of that is literally being given to you as a voucher. And why do we do it? Well, it pays our wealth consultants to get started, and ultimately it helps us get you started. Trust me, we're never going to retire selling starter packs. That's not our intention. Our intention is to get you started. For those more sophisticated investors, well, you can go on the platform. You've already seen some of the opportunities in England and Europe. In America, we've got medical buildings with an 8% plus cash on cash. These are buildings we've done in the past. We've got aged care in England with a 10% cash on cash. We've had opportunities in Australia. We don't have any right at the moment, and even South Africa where we've got cash on cash returns, and they're all on the marketplace. You know, at lunchtime today we went through the deals, we went through the platform. So if you want that recording, go and grab it, and you can literally go online and invest. And as I said, the guys are here to hold your hand through that process. So in terms of the next steps, you know, go online, book an appointment, reach out to one of the partners. As I said, I've given you Alex's room. You can see the links there in terms of getting started, and equally going to the platform. So that getting started is the starter pack, or if you want to skip all of that and just go straight to the platform, you can. You've got Lee's details, and ultimately we want people to become a global citizen. So I just want to see very quickly here if there's anything that I haven't answered. Manu said that the depreciation of the US is actually good for the American economy. It's counterintuitive, but depending on your investment horizon. So I want to be very clear here, Manu. You know, for me, what Ray Dalio says is so important. And for those of you who want to stay on, I'm going to play you a video to finish off with Ray Dalio in it. But you know, that's why diversification is so important. So I'm not saying don't invest in America, and I'm not saying don't invest in US dollars. I'm saying be diversified, which I think is key. Jay is saying confident in referrals from WealthE Migrate for investors seeking US-based growth projects. So yep, contact us, Jay. That sounds good. Thanks for the people that said it was Jay Abraham. I'd love to know if that had a recording. Thanks for all the kind messages. I'm keen on euro-based investments, especially aged care Germany and student housing Germany. Okay, Mark, I'll definitely keep that. It was so interesting on Thursday when we did the James Painter webinar, and it was so obvious we should have euro opportunities, and the last week we've really been focusing on them. And it's amazing what comes to the fore with very good quality partners. I noticed this afternoon the minimums were 1,000 on the platform. They are 1,000. If you want to invest with $100, you can, but it's through the starter pack. So we specifically set it up so that people can invest through the starter pack to be able to get on with $100. Okay, how do I join the Zoom? Okay, I think Alex has answered that, or someone's answered that for you. You literally go into Zoom and put that number in. I know Lee's put the number in the chat box. Thanks to Luke. I have another appointment, no problem. Would like to schedule a call with Lyndon, no problem, we can definitely do that. Getting into your affiliate program, happy to see ongoing development. Okay, excellent. No, thanks very much, Jay. And can share materials from Jay. Yes, please do. I'd love to. I want to do one last poll, and then I would like to. Where's the poll gone? Yeah, that's the poll there. I would like to finish off with that video. We've got a great video that I'd like to finish off with that I actually think sums up tonight. So Lee, while I've got this poll up, is there anything else that I've forgotten or anything that you would like to mention that is important for everybody?
Thanks very much, Scott. No, I think that you covered it comprehensively tonight, so thank you very much. Thank you everybody for joining us tonight. We really do appreciate you spending the last hour and a half with us. Lots of valuable information that the professor shared with us. Not quite the webinar we thought we were going to have, but what an impactful webinar. So it has been great. We look forward to sharing with you on our next WealthE Wednesday and all of our community-based activities in between there. So please do reach out to us. We love to engage with you, hear your suggestions and your thoughts. So we look forward to seeing you in our various groups and hearing from you across the month.
Just as a mantra, someone's saying the poll's not working. We had this at lunchtime, I think. If you make the poll smaller, like if it's full screen, it doesn't work. So just make the poll smaller, and then apparently it does work. Someone said that at lunchtime today. Yeah, no, so I want to echo what you said, Lee. I really appreciate everyone being online. If you think this is of value, please share it with others. And we're really excited about the opportunities coming up in Europe. And I have to say, I didn't, Alex spoke to the prof to invite him on today, and we had no conversation with him. So I mean, when we asked him about Europe, he could have said it's a load of rubbish, quite frankly. And equally the OBI opportunity. So talk about a conversation at the coalface is the best way to describe it. So fascinating to hear what he had to say as well in terms of just some of the different sectors, etc. So thanks to all of you that have voted. I really appreciate it. I'll give it another 5 seconds or so. And what I'm going to do now is I'm pretty much going to say cheers to everyone. And I'm going to finish off with a video. It's not the final product. We launched this to our shareholders last week. And now that we're tightening up some of the opportunities, we will be including the German opportunity as an example. But I wanted to just share with you this video, which is a good way to end off. So Lee, thank you very much for organizing. To everyone who's been online tonight, we really appreciate it. And I hope that you enjoy this video to finish off with. We're really excited about launching this product next week. And I think with everything happening in Europe and the currencies and everything that people, not only the Prof, but many other people are saying, this is certainly something we as investors should all be focusing on. So good night and enjoy the video. So thank you very much. I hope you all enjoyed that, and that's the end of WealthE Wednesday for this month. I hope you enjoyed that video. And what am I sharing there? No, I'm sharing my screen. So I'm going to call it tonight. I appreciate everyone's time, and see you next week. Next week we don't know when our webinar will be, but we will be launching a webinar with our partners and talking about some of the deals in Europe. Have a good evening. Cheers.